Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is CarMax Incorporated, ticker KMX. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. We'll begin with market cap. The company is a $16 billion market cap with an EV of $34 billion. What this immediately tells me, it's extremely leveraged because you have more debt than the market cap, and that's adding to a huge enterprise value. Specialty retail company, and of course it's CarMax, so I do know what it does. CarMax operates as a retailer of used vehicles in the United States. Two segments: it has CarMax Sales Operations and CarMax Auto Finance. This is pretty normal for the car dealership industry. You can see that as of February 2021, they had 220 used car stores and one new car franchise in the United States. Also useful here is they sell vehicles that are approximately 10 years old and have more than $100,000 miles. That helps you give some background on kind of where they're focusing. Now, one thing that's interesting to me as I dive a little deeper here is we scroll down and we see return on invested capital. And two things leap out. One, you have 20 straight years of profitability. The fact that this number is positive for 20 straight years tells you that they have been earning money every year for 20 years. That's always the first sign you want to see for a high quality company. Always have profits, never getting losses. Even during the bottom of 2009, you can clearly see their profitability dropped, but they stayed profitable. They didn't have losses. That's really, really important. So 3% return on invested capital in 2009, and then jump back up to 14% in 2010. Now, what I don't like to see is if you were to draw a trend line, it's relatively negative. Now, you go from earning really good returns in the early years, and they've kind of leveled out to around 5% since 2012. Now, what's good here is it is pretty stable. You got 5%, 4%, 4%, 4%, 4%. And so you've been around that 4 or 5% range now for a decade. So this could be a change in strategy. This could be a change in stuff, but this is very cyclical, but the last 10 years is very stable. Stable is much better than cyclical. So although these numbers are lower, and they're a little low for what I'd like this number to be in the 10% range instead of the 4 to 5% range, you can see that they've implemented a strategy here that's doing that. Now, what they're doing when you go to the 10-year median returns is you can see that they're taking that 5% return on invested capital and they're turning it into a 20% return on equity. Now, I like to see return on equity of 15% or more. So they're basically having 4x leverage here to take this return on invested capital from 5% up to return on equity of 20%. Now, this whole strategy works great with low interest rates. Now, interest rates are rising, so if I had to guess without looking at a stock chart, CarMax's prices have probably been crashing in terms of stock price, because the only way you can do this sort of leverage is if you can get interest rates below 4 to 5%, and that allows you to double up and have a high return on equity. But if interest rates go above 5%, if you have to borrow as a company higher than that, then you basically wipe out the equity, which is why you're seeing this big leverage rate here. Now, that does explain why you have this PE ratio of 14. I really like a PE ratio of 14. To me, an average company trades at a PE of 15 historically in the S&P 500. And so for a PE of 14, PE less than 15, you're seeing that this is trading below average. So if we can say that this is a high quality company and it's a below average price, that's very, very good for considering as a buyer. In addition, you're getting above average growth. When you see this revenue here of 12.3%, you're growing your revenue basically in line with your assets. That's perfectly fine, but you still have a little bit of operating leverage that you're seeing because your EPS has grown at 14.6% a year. That's a really strong growth rate over the course of a decade. So you're able to get a growth rate exceeding your revenue and substantially exceeding your return on invested capital. Now, how do you do that? You have to be issuing a lot of debt. You might have to be issuing shares. So I'm a little concerned about that. But you can clearly see the value that they're adding in this business when you break it down on that level, because you've gone from an earnings per share of $1.87 in 2013, and it's steadily growing almost every year. Actually, not every single year. You did drop in 2021, but basically you've been steadily growing across the entire decade to $6.97. So you're up about 4x over the course of a decade with these EPS growth rates. And without the pandemic, you might have done even better. You really, really like to see that, driving that profit growth over time. You basically tripled your revenue, which is a really good sign. Now, a big burst of that was in 2022. There's a shortage in cars, so some of this is probably some recent over-earning, but it's still overall a very strong record. All of this suggests really high-quality company, and you're getting a good price based upon this. Now, we do need to dive a little deeper because, as I said, there's that operating leverage impact. Before we do that, please like this video. Please subscribe. Your likes help me to grow the show's audience. The YouTube algorithm really uses those likes to determine whether people are enjoying the video. So if you enjoy my videos, please hit that like button every single time because that really helps me to grow the show and encourages me to keep producing videos. Also, don't forget to subscribe because your subscriptions help me build that base of an audience as I upload each new video each and every week on new companies. Now, what's interesting when we pull up this income statement, what immediately catches my eye is that I thought perhaps shares outstanding have gone up in order to facilitate that growth, but that's not what I'm seeing. They've actually cut shares outstanding over time. So those buybacks are what's driving this EPS growth to be faster than the revenue growth because the net income hasn't actually 4x'd. Net income's closer to 2.5 to 3x over the last decade, but they're closer to that, 3 to 4x on the EPS. So because of their share buybacks, you're boosting that income much faster. Now you do have gross profit doubling. You have operating profit not going up that high. So you're seeing operating profit, of course, is breaking out your net interest income. So here's that auto finance portion of the business that's really allowing the holding and paying the interest on those car loans to boost the performance more than necessarily just selling the cars themselves. So that's actually quite good performance from what I'm seeing here. Inventories you see going up over time. That makes a lot of sense for a company that's growing like this. PP&E growing up. Let's see how much of the assets. I'd really like to know what these other assets are because if you look at this other assets of 15.9 billion compared to total assets of 26 billion, that's a huge percentage. Now maybe this is the land, maybe that's the leases. It's really hard to tell from what we're seeing here, but that's important to understand because you have a very large asset base there. Maybe this is the loans. This might be the loans that they're having that's funding that net interest income. Your long-term debt basically rising at a similar rate of these other assets. So it's really offsetting here to really what they're doing. They're trying to get probably a higher interest rate from the loans that they're making, and then they're offsetting it with debt. And then that spread is really what's allowing these high returns on equity and driving that up. And what's interesting here is you see that this assets of 26 billion, and you have shareholders equity of 5 billion. So you're trading at, 3 times book value on your price to book, 3 times book. And then you also have a substantial amounts of debt on that. So you're like 3 times that book value of debt. And that's really driving this massive leverage in order to make this balance sheet work. So CarMax is really using leverage and they're really using a spread on those interest rates in order to make their business work and to give you those returns. It's been working, but the big question I have is, are they required to have low interest rates in order to make that work? You would want to do further analysis to understand that system. They do have stock-based compensation, $60 to $100 million each and every year, but you can also see that they are always buying back more shares than they're issuing, which is why those shares outstanding have declined over time. They're constantly building PP&E, that's probably new dealerships. And this change in working capital is probably the rise in the loan rate, if I had to guess, which is why you see this cash flow from operations. You have quite a few years negative. It's because of how this car dealership business works that cash flow from operations is going to be negative when they're growing their receivables, they're growing those car loans. That's allowing them to earn these net interest income. So the net income is probably a more useful number for you when analyzing this company than the cash flow. But it's something to be aware of that they are running negative cash flow in order to fund this growth over time. And then that's why they're having to issue the debt in order to support that business growth. So I like this company. I think it's a really interesting business. I don't like how low the returns on invested capital are. I'd really like this number to be higher, but they're clearly managing it well in order to turn a 5% return on invested capital into a strong return on equity of 20%. If you're able to have a return on equity of 20%, you're able to drive revenue growth of 12%. You're able to drive EPS growth of 14% over the long haul. And if they continue this and replicate this for another decade, a PE of 14 is going to be very, very cheap. So I like this company. To me, CarMax would go on my watch list. Car dealerships have been very interesting to me recently, and this is one that is clearly being managed well. You see the stability here. This is maybe startup time. I don't really know much about this previous decade, but you can see over the last decade, of course, it's all been low interest rates, has been a very stable, strong business. Thank you for listening to this episode. If you enjoyed it, please hit that like button. Please subscribe and ring the bell so you can get notified as I upload new investing videos each and every week. Thank you for listening, and until next time, stop paying fees, start building wealth.